Today, the Fed speaks after the bell as inflation holds higher. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news, and this is our weekly market update. We start in the US, go across to Europe, then Asia, and then Australia, and cover oil and gold, and also crypto. In a foreshortened trading week, the Dow and the S&P 500 closed at new record highs on Thursday, notching up its best first quarter performance since 2009, supported by the AI boom, and as the rally broadened out beyond tech, amid optimism on rate cuts coming soon, while data signaled potentially a soft landing for the US economy. MSCI's gauge of stocks across the globe fell very slightly. In fact, the index was up over 7% for this first quarter. The S&P 500 benchmark index closed up 0.1% to 5,254, having touched an intraday high of 5,264 around mid-afternoon. The Dow advanced 0.1%, losing early momentum with a run towards 40,000. The Nasdaq Composite slipped 0.12%. Microsoft and OpenAI are working on plans for a data center project that could cost as much as $100 billion and to include an artificial intelligence supercomputer called Stargate, set to launch in 2028. The Information reported this on Friday. Expenses for the plan could exceed $115 billion, more than triple Microsoft's expenditure last year on capital spending for servers, buildings, and other equipment. Anyway, all up, for the first 3 months of 2024, the S&P 500 rallied 10.2%. Nearly 40% of all trading days in the quarter were recorded higher for the index. The Nasdaq gained 9.1% for the quarter and the Dow 5.6%. But additional information, including the core PCE inflation metric, the Federal Reserve's preferred price measure, came out on Holiday Friday. The so-called core personal consumption expenditures price index that strips out the volatile food and energy components increased 0.3% from the prior month, and that followed a 0.5% reading in January, marking the biggest back-to-back gain in a year. Fourth quarter PCE inflation was revised slightly lower, though, and the measure is up 2.8% from a year earlier, which is still, of course, above the Fed's 2% target. Services inflation, excluding housing and energy, which tends to be stickier, stepped down to 0.2% from a month ago after a 0.7% surge in January, as healthcare and financial services registered smaller increases than in the prior month. So Fed officials may nonetheless take some comfort, but at the same time, inflation-adjusted consumer spending exceeded all estimates on the heels of the bigger gains in wages over a year, according to the BEA report. Consumer spending was revised higher at the end of last year on the back of stronger outlays for healthcare and financial services, even as goods spending was weaker than originally estimated. Services spending surged by the most since July 2021, bolstered by international travel, transportation, and financial services. Goods outlays, meanwhile, edged up after a steep drop in the prior month, and also helped by auto sales. Data on Thursday showed the US economy grew faster than previously estimated in the fourth quarter, lifted by strong consumer spending and business investment in non-residential structures like factories. Gross domestic product increased at a 3.4% annualized rate last quarter, revised up from the previously reported 3.2% pace. And a separate report showed initial claims for state unemployment benefits fell 2,000 to a seasonally adjusted 210,000 for the week ended March the 23rd. Chair Jerome Powell on Friday said the figures were, quote, pretty much in line with our expectations, and reiterated the central bank didn't need to rush to cut interest rates.
Morning, PCE came out this morning. You had it yesterday, 2.8% at the core. Here's my question. You saw it yesterday. What was your first thought?
My first thought was that the report that came out this morning is pretty much in line with our expectations. So core PCE, as you mentioned, is at 2.8% on a 12-month basis. Headline is at 2.5%. That's what we were expecting, and it's good to see something coming in line with expectations.
So as you and your colleagues at Fed and at the regional banks have been saying, we want more data, more good data. Is this that? Is this in that bucket?
Well, let's take a step back. Over the course of the second half of last year, we got what I would definitely consider good data over the course of 7 months. And then in January of this year, we got a very high reading, much higher reading on inflation. And so February is lower, but it's not as low as most of the good readings we got in the second half of last year. But it's definitely more along the lines of what we want to see. What we've said is that we don't see it as likely to be appropriate that we would begin to reduce interest rates until the committee, the Federal Open Market Committee, is confident that inflation is moving down to 2% on a sustained basis. And what do we need to get that confidence? It's just more good inflation readings, like the ones we were getting last year.
With all possible respect, you all of you have been saying the same thing for now 6 months, right? We want more good data. What do you suppose it does to the listening public and to the professionals who are listening to this when you keep saying the same thing?
So we're steady. Our hand is a steady hand in this. We've been saying all through last year and this year that we're making progress. We've noted that progress. We haven't overreacted to it. We didn't overreact to the good data we had in the second half of last year. You heard us saying that this is good, but we need to see more. And you won't hear us overreacting to these 2 months that are higher. The reason that's important is that the decision to begin to reduce rates is a very, very important one because the risks are two-sided. If we reduce rates too soon, there's a chance that inflation would pop back and we'd have to come back in, and that would be very disruptive. That would not be a good thing for the economy. There's also a risk that we would wait too long, and we would in that case, it could be unnecessary, unneeded damage to the economy and perhaps the labor market.
Policymakers will have access to one more PCE report, in addition to others on consumer and producer prices, as well as employment, before the next meeting starts on April the 30th. We really just haven't seen that consumer fatigue that we were getting some hints of in last month's data, said Sarah House, a senior economist at Wells Fargo. That's going to make it really hard, I think, for business to hold the line on prices if consumers are still willing to splash out at these levels. While overall incomes moderated due in part to weaker dividend payments, a narrower measure of earnings, known as wages and salaries, advanced 0.8%. That's the most since the start of last year. And the savings rate fell to the lowest since the end of 2022, possibly indicating that people are dipping into savings to support spending. The overall message really hasn't changed too much, said Veronica Clark, an economist at Citigroup. It seems like February's inflation data came in line with how they were expecting, and that's in line with more prints that they will be okay with. The Fed chief said on Friday he doesn't see the possibility of a recession as elevated at this time. Still, he reiterated that unexpected weakening in the labour market could warrant a policy response from Fed officials. Governor Christopher Waller, an early proponent of raising rates high and fast to contain price pressure, said on Wednesday that disappointing inflation data from the start of the year means policymakers may need to keep rates elevated for longer than previously thought, or even reduce the overall number of rate cuts this year. Goldman Sachs' economics team this week, though, said it expects core PC inflation to decline to 2.4% by December 2024, reflecting further rebalancing in the auto, housing, rental, and labour markets. We believe the Fed will remain on hold at the current Fed funds rate of 5.25 to 5.5% until the first 25 basis point cut in June, after which we expect 25 basis point cuts in September and December, followed by 4 more cuts in 2025 and one final cut in 2026 to a terminal rate of 3.25 to 3.5%, although Powell, to my mind, did suggest that maybe rates will be higher than that. We'll see.
We have, as I mentioned, high inflation in January, somewhat less high inflation in February, and we've been saying that we expect inflation to move down to 2%, but on a path that is sometimes bumpy. So the question then is, are those just bumps, or are they something more than bumps? Is progress on inflation going to slow for more than 2 months? And that's a question, and honestly, we're just going to have to let the data tell us that. There isn't anybody who knows. And so our position is we don't know. We'll tell you what we will do if inflation does come down. And that's sort of the base case. That is what we expect. We expect inflation to come down on a sometimes bumpy path to 2%. But if that doesn't happen, then obviously our rate policy will be different. And for example, we can hold rates where they are for longer. And that's what we would do, of course, if inflation doesn't come down, if we don't see the progress we're looking at. So we kind of say that all the time.
Consensus now is rates are going to be higher for longer. They may or may not come down this year, depending on what the data says. Do you think this economy is ready for a 4.5-ish% inflationary sort of economy, right? Not inflation of 4%, but your rates at 4.6, which is where your projections have them?
So this is one of the things, we've had our policy rate at 5.3%, which is the highest rate in more than 2 decades for some time. And all through the course of 2023, we saw very strong growth. Yep. So it's, and that's partly because this has happened in a context of supply side healing, which makes its own growth, when potential output goes up. So we don't really know where rates are going to go back to when this whole thing is over. For many years, if you go back to before the global financial crisis, it wasn't unusual to see the longer term rates in the 4s. And so are we going to go back to, whereas in the sort of time between the global financial crisis and the pandemic, rates went lower and lower and lower, and it wasn't unusual to see in other countries long-term rates below zero even. In Europe. They never went that low in the United States, but they went very low. So are they going to go back up to those higher levels of the pre-global financial crisis? We really don't know. So we think that the factors that led rates that really came down over a 40-year period, mostly related to big, slow-moving things like demographics, aging population, which saves more, and productivity, low productivity, and things like that. Those things don't jump around. They're sort of slow-moving objects. But the truth is we don't know. My own expectation is I don't think rates will go back down to the very, very low levels they were at before the pandemic. But where they will turn out to settle out, it's hard to say. This economy doesn't feel like it's suffering from the current level of rates, although if you look at things like inflation-sensitive spending, then those parts of the economy are really feeling the high rates.
Not to pick at a scab, but what I hear you saying is while inflation may or may not have been transitory, rates are not actually going to be transitory. They're going to be higher for a while, and people just need to get used to that.
That might be the case. I don't know. I don't think rates will go back to the very historically low levels that they were at before the pandemic hit. I do think rates will come down are likely to be lower than they are. At least short-term rates are lower than they were right now. But I mean, we're going to have to let the data tell us the answer to that.
And the dollar gained on the euro. After Waller's remarks, the dollar index was last at 104.49, with the euro down at 1.0793. US Treasury yields were slightly firmer, with the yield on the benchmark 10-year note to 4.210% from 4.196 late on Wednesday, after 3 solid days of Treasury auctions on the 2, 5, and 7-year Treasury notes. The 2-year was up to 4.628. Oil prices rose, closing out the month higher on the prospect of OPEC Plus staying the course on production cuts, ongoing attacks on Russia's energy infrastructure, and a falling US rig count tightening crude supplies. US crude gained 2.16% to 83.12 a barrel, and Brent rose to 86.99 a barrel. Oil prices are expected to gain some momentum this year as demand picks up and outputs are curbed by the OPEC Plus producer group continuing to squeeze supply that's already been pressurized by military conflicts. Gold prices steadied near record highs as traders bought into the oil metal ahead of more clues on US inflation and interest rates. Among industrial metals, copper prices rebounded from recent losses, moving back towards 11-month peaks after a report showed that Chinese copper smelters were proposing output cuts. Spot gold steadied at $2,195 an ounce, while gold futures in April rose 1.9% to $2,254 an ounce, and that continued the rise higher this year. Societe Generale strategist Albert Edwards, who retains a bearish view on equities, said it's clear to him that the S&P 500's rally is nearing an end, and that's because the outlook for earnings has turned. Edwards said his preferred measure to gauge earnings momentum is the percentage of analysts' earnings per share estimates changes that are upgrades. A clear change in direction in analyst optimism is usually a good cyclical straw in the wind for a change of fortune for the economy. On that basis, the closely watched manufacturing ISM index, which typically moves in step with analyst optimism, is now at risk of a surprise downturn, he said. And Edwards said bulls are misreading the direction for earnings. All I can say is that for analysts' optimism on the S&P 500 to have topped out only at 50% before subsiding is not the stuff of normal cyclical recoveries, let alone an AI new era. But it's the downtrend that catches my eye, he said. Is this anemic profits backdrop really consistent with the S&P 500 rising by 1/3 in a year? Maybe it's all about Fed-induced liquidity after all. Citi's analysts have also warned about the sustainability of the current market rally. The Lekovic Index, Citi's sentiment gauge that follows everything from margin debt to short interest to put-to-call ratio, has just hit a euphoria reading, they warn. Over in Europe, European stocks were strong before the Easter holiday, with the DAX up 0.15%, the CAC 40 up 0.01%, and the UK FTSE up 0.26%. Higher interest rates and energy crises, though, are taking a toll on Eurozone economies. Germany is expected to go up 0.1% this year. It's more stagnation than a rise. Slowing Eurozone economies and gloomy growth outlooks for the next quarters back a June rate cut from the ECB, but the ECB says that it won't commit to other rate cuts beyond June before making sure that inflation is on a solid path towards the 2% policy target. And indeed, inflation numbers from Spain confirmed a rebound in consumer prices in March as the government continued to remove support that had helped temper the otherwise unbearable rise in energy prices. So yes, the last mile to reaching the 2% inflation goal is not a given for the European countries either. And that's certainly why the euro-US dollar holds ground near 1.08. It's because the ECB looks determined to continue fighting inflation. In Asia, the sumo fight between the Japanese officials and the yen bears remains intense, as the Japanese Prime Minister said on Thursday that the government will not rule out any options in addressing excessive moves in the currency markets, stressing Tokyo's resolve to step into the market if it sees the yen's fall as overdone, having slid to a 34-year low of 151.975 in the previous session. The threat of foreign exchange intervention may slow the yen sell-off at the current levels, but we saw in the past that the post-intervention effects remain limited when the market is turbocharged with opposite direction trades. It was last at 151.38. But each time currency officials in Japan have talked about this, it has less and less of an impact on yen pricing. Japan intervened in the currency markets 3 times in 2022, selling the dollar to buy yen first in September, then in October, as the yen slid towards a 32-year low of 152 to the dollar. Japan's Nikkei 225, though, ended higher on Friday, up 0.5% at 40,377, recouping some of the previous session's losses, driven by chip-related heavyweights, and has posted a record fiscal year gain of 44% amid heavy foreign buying. The index has hit successive records this month after breaking levels on February the 22nd, last seen in 1989 during the country's bubble economy. The rally was supported by foreign buying on a weaker yen and expectations that the Bank of Japan will stick with loose monetary policy despite the very small rate rise recently. Chip-related Tokyo Electron and Avantes rose 0.79% and 1.85% respectively, and the broader topics rose 0.16% to 2,768 on Friday. Meanwhile, China's central bank set the yuan fixing at the widest gap against estimates in nearly 5 months, as authorities step up efforts to prevent sharp declines in the currency. The onshore yuan was mostly flat at 7.2256 per dollar, while offshore it was weakening to 7.2213 per dollar. China's Shanghai Shenzhen CSI 300 and Shanghai Composite indices rose 0.4% and 0.3% respectively, after clocking steep losses earlier in the week on concerns over slowing economic growth and deteriorating trade ties with the US. Hong Kong's Hang Seng Index rose 0.4% and recovered mildly from recent losses. South Korea's Kospi was flat as a rally in tech stocks cooled, but India's Nifty 50 rose 0.92%. Australia's shares hit a record intraday and closing high on Thursday as gold, iron ore, and lithium miners rose amid a rebound in resource prices. The interest rate sensitive banking, property, and retail sectors also climbed as investors bet on rate cuts in the second half of 2024. The ASX 200 closed up 1% to 7,896 and topped its previous record close of 7,847 points, achieved on March the 8th. It also reached an intraday record high of 7,901. That beat the March the 8th record of 7,853. BHP added 1.4% to $44.24, and lithium bellwether Pilbara Minerals was up 2.1% to $3.83. The rally is focused on miners today, so that's an indication of a cyclical upswing, more comfort with the outlook for the global economy, said Sean Sequeira, Chief Investment Officer at Australian Eagle Asset Management. The bank's rally had taken a lot of the money flow from some of the more stable earning stocks, and now the markets might be rotating into these cyclical businesses. If so, worth watching bank stocks ahead. Gold giant Newmont climbed 3.3% as gold prices touched record highs. A rise in gold price suggests the market expects further falls in inflation, and that should support the central bank's move to cut rates later this year. Safe haven demand also remains strong, according to ANZ. Sentiment towards Australian markets was boosted by increasing signs of easing inflation in the country, which in turn presents a less hawkish outlook for the Reserve Bank of Australia, if you believe the ABS. Data on Thursday showed that Australian retail sales grew a touch less than expected in February and rose 0.3% month on month, although most of the growth was driven by one-off spending on Taylor Swift concerts. And Thursday's data came after a softer than expected reading on monthly consumer inflation earlier this week, but as I discussed earlier, this is a very partial read, so don't take it too seriously. The Australian dollar fell as low as 64.86, the weakest since March the 5th, but was last at 65.22 cents. The share market rally that has taken the ASX 200 to new highs is unlikely to continue, according to one of the country's largest investors, describing the outlook as challenging. The warning comes from Perpetual's head of investment strategy, Matthew Sherwood, who said he did not expect the market to perform particularly well considering the subdued economic outlook. He said the Reserve Bank is unlikely to cut interest rates. The market currently is quite richly priced and our valuations are elevated due to compulsory superannuation, but the earnings backdrop to me looks pretty challenging, he said, adding that the composition of the ASX means it was not favourably exposed to the technology-driven bull market in the US. I think the economy is going to slow, and I don't think our index composition is going to be much help because we're not in a mining boom or a leverage boom era anymore. Others, though, say the ASX has more to run, like TMS Capital Portfolio Manager Ben Clark, who said the ASX was running on the back of the American market. Bull markets, they're typically multi-year, around 5 years plus. If you look at America, they're probably 12 months into this bull market, he said. Or Damien Boye, a chief strategist at Barrenjoey Capital Partners, who said the stocks on the resource side had climbed on Thursday because of increased confidence that China, Australia's biggest buyer of iron ore, was, quote, stabilising the ship. We will see. Finally, in crypto, Bitcoin prices rose slightly on Thursday. They remain close to a trading range seen through most of the week amid anticipation of more cues on US interest rates and fears of more regulatory scrutiny amongst cryptocurrencies. Meanwhile, Sam Bankman-Fried, the former CEO of FTX, was sentenced to 25 years in prison for the fraud and conspiracy scheme that caused his once prominent crypto exchange to fail. SBF was fined $11 billion. Judge Lewis Kaplan announced the sentence in a Manhattan federal court on Thursday after a 2-hour hearing, and Kaplan stated that Bankman-Fried never presented a word of remorse for the commission of terrible crimes. Bitcoin was last at 70,115 US. Sentiments toward crypto markets was also rattled by a key development in the Securities and Exchange Commission's lawsuit against crypto exchange Coinbase. a US judge ruled that the lawsuit, which was announced in 2023, can move forward, but missed one claim the SEC had made against Coinbase. The SEC recently won a major legal victory against XRP token issuer Ripple and was reportedly seeking $2 billion in penalties from the firm. But the SEC Coinbase suit is a key point of focus for crypto markets, given that it could potentially determine whether crypto tokens are governed by US securities law. This uncertainty also helps to keep Bitcoin trading in its tight range. But that said, despite its treading water for 2 weeks, Bitcoin was still set for a 50% gain in the fourth quarter of 2024, boosted chiefly by an increased capital flow from the US approval of spot ETFs earlier this year. By comparison, the S&P 500 was up 11% in the first quarter, while gold was up about 6.5%. Marcus Thielen, CEO of 10x Research, recently posted an analysis hinting at a possible Bitcoin price rally. His analysis particularly focuses on Bitcoin's performance history in April, suggesting the cryptocurrency might see a 12% increase. He points out that April has historically been a good month for Bitcoin, with 6 out of the last 10 months showing strong price gains. Furthermore, the current fluctuation in Bitcoin's value are significantly linked by some analysts to the pre-halving phase. Experts note that the pre-halving retracement, a pattern found in past data, highlights Bitcoin's volatility, which often leads up to substantial price surges. So we'll see about that. But standing back, you can see here how markets are very much overdone at the moment. There is considerable certainty about the trajectory of inflation and the Fed's moves, and I don't believe that Australia will see rate cuts as soon as the markets are pricing in here. And I do note that more and more analysts are now beginning to question whether the markets are in fact overvalued, and if that's the case, then we'll see some sort of correction ahead. Who knows? We'll see. But I would continue to say that the markets are not totally logical at the moment, are trading on hopium, and as more information comes in, being data dependent of course, we might see markets reverse. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.